everybody. I thought you'd be interested, since we are in the heart of technology here, that Apple Computer now has more cash on hand than the federal government. So I thought I'd start the discussion with that. One of the things that we've been all grappling with in the news has been the debt ceiling and that whole issue. And there's, of course, many other issues behind that that are of equal importance. What I'd like to do is just first address this issue first with our panelists and talk about what happens if the debt ceiling is not raised. First of all, maybe I could go with Gary and clarify what is the debt ceiling and what does that mean?
What's a debt ceiling? What's it mean? Well, basically, it's a number put out there. Kind of think of it like a limit on your home equity line of credit that usually is pretty straightforward. You need to borrow, and the bank says, go ahead. I mean, at this point, actually, it's quite interesting because the rest of, we're not Greece. Greece, it costs 30% to borrow if you can get the funds. We're actually borrowing at 3% for the same maturity. Funds are readily available. The rest of the world is quite willing to borrow from us. We have this sort of artificial cap that we've placed there that says we won't borrow anymore. The impact of it could be quite substantial. Chairman Bernanke.
Well, the debt ceiling actually refers to money we've already committed to spending. In other words, we've committed to spending the money. Now we raise the debt ceiling to accommodate that, or
well,
is it?
No, it's actually
isn't about that.
We're one of two countries, the U.S. and Denmark, that actually has a debt ceiling, an official debt ceiling. Essentially, the budget and spending decisions made earlier in the year, we made spending decisions that will increase spending. We have to estimate tax revenues, and we have this very large budget deficit at the moment that's going to push us above that debt ceiling that's been set out there, sort of the credit limit. That's a political, personal opinion, that's a political decision, not a financial one. The rest of the world is quite willing to lend to us at very low rates. That's what happens if we broach that, of course, is that there's lots of uncertainty. What we could do to borrow, the ability for the U.S. to borrow,
right.
Could affect the value of the dollar in international exchange. So it could affect, our borrowing costs as individuals. Many of our rates are tied to the risk-free rate. U.S. Treasury security. So there's lots of potential uncertainties there that the question is, why are we going there?
Right. And Doug, maybe you can address this. One of the issues with the debt ceiling discussion is that, and I'm based in Manhattan, and all my Wall Street friends are all saying, interest rates might tick up a little bit, no big deal. What's the takeaway from in the interest rate sort of sphere with the debt ceiling? There's some talk that rates may actually drop initially and then rise. Where do we go from here if it isn't raised?
I think there's a short run and a long run problem. The short run is introducing a whole bunch of uncertainty into the financial markets, as Gary was suggesting. And depending on how they react to that, likely there'll be some rise in rates because of the increase in risk of that repayment. In the longer term, depends on how the fiscal situation in the United States is handled, whether or not that debt's going to come back down or not, whether or not the global capital markets will punish us by driving longer-term interest rates up.
And Ken, in this, because there's many other topics to talk about besides the debt ceiling, it's almost, even though it's so important, I think, it's almost a white noise issue now because it's just this constant drawn out of Washington, and we don't know what's going to happen. But aside from the debt ceiling, what's an issue that keeps you up at night?
Well, I think the most important thing to say is that our policies in Washington, spending and taxing policies, are unsustainable. We've rolled out 10, 15, 20 years. We're talking about a multi-trillion-dollar gap that we don't tax ourselves enough if we want all these services, and we have programs, Social Security, Medicare, many other programs, foreign wars, that we are not paying for. So the real issue is the cumulative amount of debt that we're having relative to our GDP is putting us in a very unsustainable path. And my thing that I worry most about is that interest rates today, they actually plunged, believe it or not, the bond plan and everything else because of the weak GDP number, but they're unsustainable. We have a 10-year treasury today of 284. Everyone in this room is tied to that because the mortgage rate is tied directly to the 10-year treasury. It's really low now, so encourage every single one of your buyers, close in the next 6 months, because rates are not going to stay this low. So when I wake up at night, it's the 10-year treasury, 3 years from now, 2 years from now, 5.5%. Mortgage rate, 7%. That is not high by historic comparison, but compared to today's bargain. So anyone who tells you they're not going to buy a house because they're worried about prices going down, the most important thing is they're locking that mortgage rate, lock it for a long term if you're going to stay in the house for a long term. So that's what I would say is the single thing I most worry about.
Right. One of the sort of new economic concepts that's been introduced to the housing market as of late is that you actually need a job to get a mortgage, and there's as a result, what we're seeing now is we're seeing this that credit in terms of lending does not appear to be easing, and that's sort of driving, keeping housing from going beyond where it is. We have unemployment at a very high level. What's the outlook for, and maybe Doug could address this, what's the outlook going forward for credit? Are we looking at 3 to 5 years down the road, do you think, where we see some sort of easing? Is it just strictly correlated with unemployment, which seems to be sort of stuck around 9%? What's the outlook for credit?
Well, I think you've heard a lot of use of the term the new normal.
Yes.
And I personally view this as an environment in which we're returning to the old normal. So you've seen underwriting criteria, to your point about people having a job, it also helps if they have an income from that job. Those are kind of old normal criteria. I don't think that's going to change dramatically in the near term. The key issue is unemployment today. But if you think about the house price bubble, and you think about the path that took, you have to unwind some of that path. What do I mean by that? The asset in which the bubble took place is on the household balance sheets of 70% of our households. So when that asset started appreciating in value, we had in our market structures and our tax code advantages for people to tap that equity. So they did in large quantities, and they consumed. That consumption became sales and profits to businesses who compensated their employees more as a result. The belief of the household was that that was a permanent appreciation of that asset, but guess what? It reversed itself. Not only did it reverse itself, but for many households today, the value of that asset is now lower than the fixed obligation they have to pay for that.
Right.
So not only do you have to solve that problem on the household's balance sheet, but you're also casting a bunch of policies against the pain of adjusting back to that old normal.
Right, and are we looking at a couple of quarters down the road? Are we looking at a couple of years? Are we looking at a decade where we sort of see some sort of stability return in terms of the wave of foreclosures to cool, the credit condition to ease? I mean, are we talking short term or long term?
You might not like the answer to that one. I would say we are 4.5 to 5 years through a 10-year adjustment period. Now, that's to complete the restructuring of the secondary market. I've thrown that in there because Fannie and Freddie are going to get revised. That's not going to happen until after the next presidential election.
Right.
So you can, in my view, start to kick off in either 2005 or 2006. In the middle of 2005, the peak of momentum in the market happened when condo prices, for the first time in 4 years, started slowing relative to the rest of the market. That's really when the market peaked.
Right.
Prices across the whole market didn't peak until 2006. But then you started the decline in financial markets at the end of 2006 with HSBC writing down $9 billion of their investment in household finance. That's when the rout started. So I'll take that forward in time. We're now about 5 years to possibly 6 years to do that.
In theory, we're halfway.
Yeah, a little over halfway, perhaps.
Right, interesting. Well, that's really cheery.
You said you had too much energy in that first show, so we're
trying to bring us up from
I think it's really very market specific. Here in Silicon Valley, it's booming. There's money there, jobs and wealth. So it's getting better very, very rapidly. If you're in Phoenix, a lot of distress sales are happening where you have so much overbuilding, and that price bubble was completely false. It wasn't a national price bubble, it was market by market. Phoenix was crazed. People were buying them for investment purposes, putting down $1,000, $5,000 and buying 10 houses. They should be put in jail. Period. That ruined the market for all the rest of us. So the speculative bubble was in certain places. I think we go back to think of housing as a consumption good. People buy it to live in it and consume. And a good investment over 5 or 10 years, I'd say now is the bottom of the price cycle. I think in terms of robust, new production, I think Doug is right. It's going to take a long time. Remember, the policies in Washington are now tilting against homeownership in a very big way. This is bad. We have to stop it. Otherwise, the homeownership rate, which has gone from 69.2 to 66.4, is going to go lower. People want to buy houses, but they're going to change the policies to make it more difficult. And we'll talk about that later.
Yeah. And actually, just following that, Gary, I wanted to ask you, one of the things that the former GSEs, Fannie and Freddie, were looking at lowering conforming mortgage rates. And just in looking at many housing markets across the country, one of the markets that are the segment of the market in certain metropolitan areas that seem to be faring better is the high end. Not across the board, but we're seeing that. We're seeing a lot of all cash purchases, and it's a sort of a different type of market behavior. One of the things that's going to happen in the fall is that the conforming mortgage rates, the limit on the size of a mortgage that Fannie or Freddie will buy, is going to drop in the high price housing markets from $729,000, $750,000 to about $625,500. What's the repercussion of that? Is that a big deal? Do we see that as a significant problem, or is it just